Welcome in, folks. It's a three-piece for me to react to in this one. Three videos up here. SoFi CEO Anthony Noto went on CNBC this morning, spoke about the state of the economy, where his business is at. He spoke about the stock price, what's going on there. He spoke about, let's call it who he wants to win the election, a lot of different subjects. Very important video to watch here today. And the reason this is actually a great time for him to go on is the stock has been absolutely tanking. We know the business results have been better than ever by far when it comes to any metric basically you want to look at. But with that being said, the stock price cannot stop falling. I mean, just yesterday, $6.36 a share. So great time for him to go on. Happy he went on, and we'll react to that one and talk about that, okay? Weaker macro data raises prospect of fall rate cuts, and then Powell sets a table for rate cuts before 2% inflation target. So looking forward to reacting to those ones and sharing my opinions and perspectives in there, okay? Appreciate y'all joining me as always. Thanks so much for being here, folks. We're up to the 2,692nd most subscribed channel here on YouTube, so I appreciate every single person subscribed to the channel. And it amazes me like how loyal the subscriber base is in the finance niche. Not the most viewed videos, certainly, right? But in terms of subscribers, man, very, very loyal. Total views, 855,000, yet top 3,000 in regards to subscribers. So appreciate y'all being here. I mean, I got people that have been watching the main channel now for 5, 6, 7 years. It's absolutely incredible to hear some of those stories. All right, guys, let's get into this.
Before we talk about your business, I want to talk more big picture about the conversation here in Sun Valley, specifically about the...
Wait a minute. I already don't like something. What is it I don't like? Come on, Anthony Noto. Where's the Nikes at, man? He's wearing those ons.
Economy, given your purview through your business, as well as the conversations you've been having with other CEOs, what's your sense of the economy right now?
Yeah, I'd say the conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We've came out of that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, but not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive. As it relates to the consumer, we've seen really good trends in spending. We've seen really strong demand for refinancing personal loans as people are trying to lower their debt so they can make sure they're planning for the future. So overall, our company's performed really well in this environment. I'm glad we took the stance of lower rate cuts than everyone else because it's positioned us now to benefit when rates start to come down. So I like how we're positioned. And for the first time, I'd say in 2 years, there's a more central consensus view about rates and where credit is. And credit actually has performed relatively well throughout the year. And that's something I heard from a couple CEOs last night. And we're really happy with where it's performed as well, in line with our tolerance levels and our expectations. So all in all, I think we're setting up for a pretty strong back half of the year in 2025 if we get the right fiscal policy.
Well, we're going to talk.
Okay, so confident. I like that. He did kind of leave himself a little scapegoat there at the end, as long as the fiscal policy's right, which it sounds like he really wants, at least 1 to 2 rate cuts this year. He also mentions, specifically, I think it's very important here. He mentions we're off to a good start this quarter.
Conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then.
We're really pleased, that's where these little sneaky things here that you can miss over, right? We're really pleased with how things have gone since then, right? I think that's an important statement.
Business, which is a really strong quarter, and we're really pleased with how things have gone since then.
We're really pleased with how things have gone since then. I think that's really important right there, right? So definitely good to hear overall. And the lending business, it's tough. It's banking, right? And it must be done. Otherwise, how are you going to have a banking business if you don't lend? But at the same time, there's always that risk whenever you're a lender in the market, right? Of like, well, what happens if recession happens and people don't pay and all those sorts of things. So are things to be considered.
You mentioned you're not doing as many student loans. What is behind that policy, and where are you shifting your focus to effectively follow or lead consumers and where you want to be growing the business?
Sure. As we came into 2024, there was a view that actually rates would be cut 4 or 5 times. And we believed that for rates to be cut that frequently, there would have to be a recession or some type of underlying problem. It turns out we'll get 1 to 2 rate cuts, which is where we've been positioned. And as we thought about the environment and thought about how much we invested in our financial services business, our SoFi Money product, our SoFi Invest product, our credit card product, as well as our technology platform, we had an opportunity to drive really strong growth there at 50% and really pull back in the lending business to be more conservative, to wait to see where the economy shakes out, where interest rates shake out. And now we're coming into a picture where that's a lot clearer. So we've delivered really strong growth without really using the lending business to help drive it. And now we're in a position where, as we go into 2025, to use both.
Now, of course, your business all started with student loans. And then just last week, a federal appeals court allowed a key part of Biden's student loan repayment plan to resume, staying in an order that had temporarily blocked it. Now, there's been a lot of back and forth on this. But how does Biden's efforts to repay student loans impact your business? And how?
Now, very important. Remember what they're talking about right here. Remember what's been going on with all the student loan drama, right? Remember how that's hurt SoFi. And then remember all that when we come to the portion where it talks about who would you rather favor to be in the White House. So keep all that in mind.
See some of these legal changes and sort of the whole appeals process and the outcomes impacting your business going forward.
Yeah, we've really focused on people that have private student loans. Those are people that are still managing their cost and giving them cost savings on refinancing their private student loans, and that's been a smart strategy. It's a much smaller percent of our business. We gave guidance that we'll do close to $2.5 billion of revenue this year. We'll see really strong growth from the other businesses. So we're much less dependent on it. The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing for consumers in our SoFi Money product with 4.6% interest rate, SoFi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political winds are blowing as it relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a refinancing business. We've invested a lot in being able to do purchase home loans, and we're now seeing that pick up and gaining market share there. And we've recently made the decision on home equity lines to give people even lower costs of debt. So as rates come down, we'll see a real pickup, and as long as the economy is stable and inflation is stable.
So you've mentioned various ways that your business is growing, but your stock is way down. Stock's down about 35% year to date, down about 19% since your last earnings report. I know that you have earnings coming up in a few weeks, so you're limited in terms of how many specifics you can share. But what's your message to investors? Why should they hold on when the stock is down so dramatically?
Yeah. The thing that we can control is our strategy and our execution. And for the last 7.5 years, our strategy has been consistent and our execution has been consistent. We've driven good, steady growth. When I joined the company, we had less than $300 million of revenue in 2018. Now we're over $2 billion of revenue. We weren't generating profits. We weren't generating positive EBITDA. Now we're generating both positive EBITDA and GAAP profitability. Boom. So I'm really pleased with what we're doing. In terms of the stock, I'm equally disappointed. I'm a big investor. Our employees are large investors. What we've seen and what we believe is happening is that the group of fintech companies that have credit exposure has been really hit hard, and they've been hit hard because of the uncertainty around interest rates. When will interest rates peak, and when will credit peak? And as I mentioned, we're really pleased with where credit's performed. We expected it to pick up a little bit, but it's within our tolerance levels, so a good sign there. And as I mentioned, 1 to 2 rate cuts would be welcomed and moving in the right direction.
And what about AI? Well,
so I think the important thing to understand about what's going on with SoFi's stock price is if we don't get any major recession in the next year or two, what's going on with SoFi stock is absolutely ridiculous. It's a steal deal, and this stock will go to, $18, $20, $22 a share. If we get that big recession in the next year or two, this all makes sense. You can understand why it went down to $6, right? If that big recession hits, we get a big unemployment cycle. If credit delinquencies go up in a substantial way, people's credits drop in general in a substantial way, right? Then it all makes sense. And it's like, oh yeah, we get it. Like that made sense to put SoFi down to 6 because the market was pricing in bad stuff that was going to happen in the economy. So that's the way I would look at it is, yeah, big recession, this all makes sense. Not a big recession, then this is absolutely silly to be pricing SoFi at $6 a share.
The one to bring AI to retail banking, and will that really accelerate your results?
Yeah, there's a whole spectrum of technologies that we use every day to ensure that our product is safe, it's reliable, and we can be a trusted partner. Where we want to use AI is to fortify those areas, but we also want to use it to answer 3 questions every day. Because this is a financial show and we operate in a financial world, people want to talk about interest rates and consumer spending. We don't spend a ton of time talking about the product, but we are a product company, and my vision for the product is that you open up SoFi every day and you go to your member home feed just like you would to your Twitter home feed or your Facebook home feed or LinkedIn home feed, but we answer 3 questions for you in a personalized way. What must you do in your financial life that day? What should you do and what can you do? AI allows us to take all the data.
That's awesome, Anthony Noto. Awesome. But 90% plus the population doesn't give a crap about that. If you think they're going to log in to see what they can do that day on when it comes to their money, I wish it was like that. I really do. I really do. But it's not. They would much rather watch TikTok. They would much rather watch Instagram. They would much rather go on X and surf around. That's what, this is just humans we're talking about here. I wish they really cared about their money like that, but they don't. Let's just call it what it is. We can act like it's going to be this way or that way, and it would be sweet. Wish it was like that, but it's not. And that's unfortunate.
You and everyone else, and answer those 3 questions.
Just a final question about politics, because I know the conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular?
Looks beautiful. I just want to run through those fields right now.
Well, I'll make an analogy. I went to West Point and I played football, and I want Navy to win 364 days of the year. But on that one day when they play Army, I want Army to win. And so I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
So, who did Anthony Noto just say he's voting for? And who he wants to win the election? Well, it's very clear. He wants it to be a red show, right? So, does it come as a surprise to me that he would come out and say that? Not really. Not really. I mean, listen, look what's happened with the student loans and the forgiveness and the forbearance and all that, and then dragging on and on and on. And look at how that, hurt SoFi's business model, the stock price, a lot of different things, right? And look at, inflation. So a lot of people, aren't happy with the current situation and kind of how the country's been run recently. And so does it surprise me that he comes out and says something like that? No, it doesn't. Is Anthony Noto a Democrat at heart? I don't know. I have no clue. He might be a liberal. He might always be a Republican. I don't know. But I understand his point there, right? So it doesn't surprise me. If anybody was surprised by him coming out and saying that, let me know in the comments. I'm actually not surprised, really. Weaker macro data raises prospect of fall rate cuts.
Let's ask strategy. Let's talk it with Dan Greenhouse of Solus Alternative Asset Management here with me at Post 9. Do you think I framed this right, a rate cut rally? Because I think over the last couple of days, the chair was pretty dovish on the Hill and continues to set the table for what's going to happen in, we think, a couple of months.
Yeah, I think that's right. I don't think he said anything new, but it's all from the equity market standpoint. It's always nice to hear the Federal Reserve Chairman tell you the types of things that you want to hear, like the labor markets loosening up a little bit and the odds of us hiking rates in the next couple of months are going up. And that's effectively what he said yesterday and today.
Well, I mean, the labor market is, weak. He sees weakness. there.
Because there is weakness.
Well, and that's the thing, right? They've been solely focused on inflation for this whole run over more than 18 months. It's a dual mandate.
Yep.
And now they have to worry about the labor market getting away from them. You've got the unemployment rate at 4.1. You don't want that to start to get to the point where they can't control it. So he's talking now about the two-sided risks, where before it was the principal risk of going too soon and cutting. Now, maybe the bigger risk is waiting too long to do it.
Yeah, my friend Michael Gapin, the chief economist over at Bank of America, titled his note "The Return of the Dual Mandate," because the idea is, of course, that now with inflation on track, according to the Fed, to be back within the realm of what they deem acceptable over the next couple of months, and the labor market weakening, you have to start paying attention to the other side of your mandate. I would take issue with the idea about the Fed, quote unquote, controlling it, because I think there's we put way more faith in the Fed than I think we should.
No, my point is, like, look, they've gotten this far, and they sound close to declaring victory.
Well, it's always darkest before the dawn and all that.
They sound close to being able to declare victory. They don't want to mess it up.
Yeah, but a point I've made with you numerous times, and I'll repeat again, is we cannot declare a soft landing until they've reduced interest rates by some amount, which we can discuss another time, without having caused a recession or a recession occurring simultaneously. Yes, things have gone better than I thought and predicted 12, 18, 24 months ago. I'm losing track of how long it's been at this point. But the idea that they can cut rates, let's call it 100, 150 basis points, and glide path the economy into...
I don't want to miss that point, because that was huge, right? Listen, let's say the Fed makes their first cut 2 months from now, and it's not like obvious there's a recession going on at that time in terms of like the government numbers or whatever, right? Can you declare soft landing? No, absolutely not. You have to go through kind of the rate cut cycle, right? And wherever that kind of wraps up at, and then try to figure out, did you make it to a soft landing or not, right? I mean, you could go back to the great financial crisis and the Fed started cutting rates, right? And next thing you know, it was a mess. So let's say the Fed starts cutting rates 2 months from now, 4 months from now, whatever. Let's call it 2 or 4 months from now. Okay. Who's to say 6 months from now it's not a mess, right? Or 9 months from now it's not a mess as far as the economy, and unemployment rate's not going up substantially at that particular time. So that's happening while the Fed's cutting. You didn't make it to a soft landing. You still got that hard landing, or at least a medium landing, right? So something that has to be taken into account.
Landing is effectively what the market is betting on, but their ability to do that, I think, remains something of an open question. I think the odds are at this point that they're going to, but again, my point is just to repeat, until they've done it, I don't think we can declare anything resembling a soft landing.
I keep hearing people say, well, the market's due for a correction. And then it goes up.
It's always due for a correction.
I mean, does it feel like a correction's going to come? I mean, it's only due for a correction because you really haven't had one. That's the only reason you can say and make the case, well, it's due for correction.
Listen,
why? Because we haven't really had one.
That's right. Well, we've been doing this for 20-something years now. Anytime the market's going up, someone's coming around telling me that it's due for a correction. What I would add to that conversation is,
that's true.
And I keep coming back to this, the divergence between the S&P market cap and the S&P equal weight. The S&P market cap obviously continues to make new highs, as you mentioned, now back north of...
Holy smokes, did they open up a Tesla factory in my neighborhood? All it is Model Ys and Model Ys going around. Literally, just a Model Y went by, then a white one, then a red one just went by, and now a blue one just went by the other way. It's like, I think they got a gigafactory in the neighborhood.
We're now north of 5,600. The equal weight's traded sideways since early May. And there's a lot of stuff under the headline that is down 15, 20% from the highs. A lot of the restaurant stocks, throw up a chart of either McDonald's or Starbucks, two of the largest restaurant names. The home builders obviously have had a real tough go of it. Some of the better performing momentum names we've talked about, like Deckers, have really run into trouble here. So under that headline, there's been some pain. It's just that AI...
Deckers has run into trouble? No, not them. Really? I don't really cover Deckers much. And then very base level. What? Oh, this is a one-day chart we're looking at. Oh, shoot. Yeah. Dang, okay. So it had a blow off top to around $1,100. And now it's sitting at $893. Interesting. But, I mean, to be fair, it's just back where it was back in May. But that is a big fall. That is a big fall from here. It's just like, it's not as extreme as it sounds, right? It's not like a Lulu situation where Lulu is down like 1 billion% this year. Okay, it's not that quite that dramatic. But Lulu, let's pull up Lulu here. So Lulu year to date, sitting down 43%. Lulu, ooh, that's ugly. That's ugly. They had a great discussion on Fast Money about Lulu stock, by the way, today. It was very interesting.
It has continued uninterrupted, and that's holding up the bigger market cap weighted index. But again, I think you've had something of a sideways, if not downward, correction for a lot of names under the headline.
Does that pain under the surface knock the patient on its back at some point, or is there just enough strength in the rest of the being to keep this market going up?
Listen, if for some reason tomorrow, if we found out that all of this was double ordering, let's say, and Nvidia and Apple and all Meta and the tangential names, if you will, the power names, et cetera, all sold off, yeah, the market cap weighted index would fall, of course. But I think at the end of the day, if the economy continues to do what we think it's going to do, and by we I mean, let's say, just say the consensus, and earnings do what are expected to do over the next 12 months, then you'll find some equilibrium, at which point the market, the equal weight, let's say, can begin moving higher again, even if that happens. But that said, I will just repeat, I see nothing, and I'm not and I've said this 100 times, Solus nor I are some great tech investor, but I've seen nothing in the macro data or in the company-specific data that says that there's some immediate worry to be concerned about.
Do you think that earnings expectations are too optimistic, given the economy is clearly showing signs of slowing? And if you look at any number of data metrics, it will suggest that.
Yeah, well, listen, do I think it's too optimistic? Probably. Do I think that means the market needs to go down because earnings expectations will come down? I'll give you the same answer I've given you the last 18 months, which is no. The market is generally too optimistic, and into any given earnings season, expectations come down. That's a perfectly normal thing to have happen. And then when earnings season actually happens, we end up beating by anywhere between, let's call it 2 and 5%, something like that, depending on what time frame you want to look at. I don't see any reason that this earnings season is not going to be any different.
Alrighty, let's get into this next one with a panel here talking about rate cuts.
Today, before the House Financial Services Committee down in Washington, bring you any more headlines that you need to know about. There have been several.
By the way, we had 10 people. 10 people hit six-figure club in the private group, and 2 people hit $1 million plus in the private group. So congrats to you guys. Those awards are being sent out today. I believe my wife's sending them out, so I signed them all up today. So congrats to you guys. If you're looking to apply to join my private group, I'll put that as a pinned comment down there today. You can click on that, fill out an application, see if we can get you in there. Access to all my best courses, access to Discord chat, exclusive videos, all that good stuff.
To this point that are rather significant. Perhaps the reason why the stock market is near the highs of the day, extending those record highs on the S&P and the NASDAQ, but Dow's good for about 160 as well. You could make the case that the Fed chair really stayed the course to what he said yesterday before Senate banking, setting the table, if you will, for a rate cut over the next couple of months. He did say today not going to wait until 2% to cut rates. Job not done, but inflation is moving substantially and sustainably down to target, but also mentioned the labor market once again, which he says has cooled rather significantly. I've got the investment committee with me here, Joe Terranova, Shannon Sakosha, Brian Belsky, Farmer Jim Lebenthal. I mean, that's what we're talking about today. He continues to make the case. He talks about the two-sided risks, but he continues to underscore that the labor market has cooled, and he knows they're on the clock, that they need to do something before the labor market gets out of hand.
Absolutely, and he's focused on the labor market. They have a dual mandate. It's inflation and labor. He told you already he doesn't need 2% on inflation for the Federal Reserve to cut rates. He's focused on what's going on in the labor market. He told you it's cooling significantly. The rate cut is coming in September. The market is pricing it in, and you're actually getting a little bit bit of the broadening out today.
Brian Belsky, you've got your 5,600 target.
Not
We're
really.
above that level for the first time ever.
Yep, welcome
today.
to the year end.
But you say you're sticking with it. Why are you sticking with it?
You know, we are. 7 months ago, when we came out and talked about this market, we said that in the second year of a bull market, you typically see a 9.4% correction. We've only had a 5.5% correction. And we still think there's way too many bulls out there, and we think there's a very good chance we get a pullback. Now, our bull case is for 6,000. We really think that we get a better buying opportunity to add to stocks, and then we'll have a very strong recovery from that to the tune of 15 to 20%, which is on average.
Yeah, it's just a flawed way of thinking. I don't want to say it's a flawed way of thinking. It's a flawed way of investing, which then you could say is also a flawed way of thinking. But it's a flawed way of investing. Listen, guys, that's like me saying, I really like Nike stock 71, but maybe it's going to have a correction and it's going to go to 62, and so I'll wait to 62. Okay, it's a flawed way of investing because a lot of times what you're hoping, the stock never goes there, okay? So if you feel like it's a great deal, you got to take advantage of that deal, right? If you think the market's going to 6,000, you've got to buy at 5,500, not like, oh, maybe I can get it at 5,400 and then it will go. Like, it's a flawed way of investing, guys. It's absolutely ridiculous. So don't do that sort of stuff. These guys all try to do it, and it usually ends bad.
Why shouldn't you be bullish, given what the Fed chair is telling you?
The market's got it right today. I mean, this is amazing. Yeah.
Well,
so
just today?
No. Well, let's talk about today. I think the market has gotten it right in terms of the path of interest rates. Now, it just means that I just think that the momentum is too centered on buying right now. We're going to get a little overbought on a technical basis. From a fundamental perspective, we still believe that we're in a 25-year secular bull market, Scott. This is the second year of the cyclical bull part of it, and we're going to get a pullback.
More worried than you've been in years is what you told us the other day.
True.
Give us, a read into your psyche and what you're thinking about this market today. As we said, we're extending the record highs. S&P 500 above 5,600 for the first time ever. Technology's leading. NASDAQ's good for, 0.75% today as rates are down and kind of everything's up. The financials are the only sector that's in the red.
Yeah, well, I'm going to field the question you gave to Brian just a second ago of, why wouldn't the markets be bullish? Is because the string of rather poor economic reports that we've had for several weeks now. I won't go through a long list, but we've seen initial weekly jobless claims and continuing claims pop up. We saw ISM services go below 50. I don't want to go through a long list, but here's the good news. If Joe is right, and I think he is, by the way, that what Chairman Powell is saying is that we'll get a rate cut in September, we can make it through. It's going to be a bumpy ride, and it actually critically depends on the earnings reports coming up, not just being good for the second quarter, because who cares? We already know that was good. What it critically depends on is the guidance going forward.
These Wall Streeters make such a big mistake, such a huge mistake. They think that because the Fed starts cutting rates, it's going to fix all the issues with, let's say, the economy. It's not how it works. Remember where the Fed funds rate is at right now, right? We're at, 5.5? Something like that? Okay, so let's say the Fed cuts in September. How much are they going to cut? The one, it's still a question if they're going to cut in September, but let's say they do. How much are they going to cut? I'll tell you how much. 25 basis points. 25 basis points on a 5.5% rate is nothing. Nothing. If you think that's going to magically change the economy for the better or the worse, it's not going to do anything. No different than if the Fed raised 0.25. It's going to do a whole lot of nothing, right? Other than it just kind of send bad signals to the market. But does it actually do anything underlying? Not really. So for the Fed, if they came out and they lowered, Fed funds rate by 100 basis points, it's a whole different ballgame. That's a full percentage, right? Okay, now we're talking. 200 basis points, 2 full percentage points. So then taking Fed funds rate down 3.25, 3.5. Okay, now we're talking. But how long is it going to take till we get the Fed funds rate down even 100 basis points? Never mind 200. It's going to take a year, if not 2 years, to get down there outside of the economy completely falling off the rails. So the damage that's being done by Fed funds rate is going to continue to eat up this economy and continue to eat up a lot of companies for at least a year, likely, okay? So that's what's important to remember here. And they're all thinking like it's just going to be great because the Fed's going to lower 25 basis points. I'm like, it doesn't work that way. It's good that they're signaling they're going lower, but we're like way up. It's like Mount Everest we're on right now, right? There's the highest Fed funds rate we've had in like 20 years. So picture we're up on Mount Everest, and we go down our first 50 feet and we're celebrating, right? Like there's still a long way down that mountain than 50 feet, I can tell you that much, right? And that's the way I'd view this whole situation in regards to the Fed lowering rates and things like that.
Tomorrow, Scott, you know that. Mr. Bastian, the CEO of Delta, here's a guy who is generally quite optimistic. The last thing in the world that you want to see is him saying something negative about demand going forward for air travel. I mean, that would make it difficult to bridge the 2 months from here until that first rate cut. And I know there's some people who are saying, what does 25 basis points really matter? It's a clear sign that they're going to continue to lower
rates. It matters as much as it mattered on the way up.
Exactly.
It's the beginning.
Exactly.
Of
if you don't fight the Fed on the way up, then you applaud them on the way down.
Shan, 6,000, the highest target we have on the street from Evercore ISI. Has the market got this right?
I think they may. I think that the challenge, they may. With a higher probability than 50%.
Okay. Why the hesitation?
Well, I think the path to get there is critically important. So what haven't we talked about today? What haven't we talked about? The bond market. What haven't we talked about? Expectations of potentially higher fiscal spending to thwart the efforts of the Fed to bring inflation down. Those are concerns that we start to see crop up perhaps in that August, September, October timeframe. When you start to think about what derailed us last year, Scott, was it fundamentals in the stock market? No, it was concerns about the bond market. It was
concerns about the bond market. Now their rates would be moving up. In fact, they're not. That story's known.
They're not right now. So I think the challenge here goes back to Jim's comment. We are looking at an environment where everything that the Fed is looking at and everything that many economists are looking at are in the rearview mirror. So does the macro matter right now to keep this rally going? Probably not as much as it did if we get that rate cut in September, because then the macro picture is known. More about the guidance of the second half of the year. Where are we seeing slowing? But more importantly, where are we going to see growth? Are we going to finally see reshoring? Are we going to see industrial capex? Are we going to see the financials come out and talk about a rebirth in capital market activity? Because there's going to have to be something where you see earnings growth slow incrementally in big tech. Earnings growth is expected to pick up for outside of big tech, but you need to see that in the next 3 or 4 quarters to keep the dream alive.
Yes, no doubt about that, 100%. So yeah, we're at a very interesting standpoint, and at the end of the day, we all just need to keep in mind that when the Fed does lower, whether that's September, whether that's November, whatever, okay, whenever that move does happen, just keep in mind that it doesn't really change much of anything, other than the Fed's signaling they're entering a rate cut cycle, right? That's all that signals. But it doesn't actually make any substantial difference to the underlying economy. It doesn't make any substantial difference to the damage that's being done in the economy from high interest rates over a long period of time, right? The Fed lags catch up more and more the longer Fed funds rates at a much more elevated place than it's been over the past 10, 20 years, right? And so these are just all, things that just you got to factor in. That's why I have some hedges on the market. Guess what? Next year, I'm going to have hedges on in the market as well. Okay. Appreciate y'all joining me as always. Thank you so much for being here. If you're looking to apply, join my private group and learn everything I got up here, including hedging strategies, as well as everything I look for in a stock to value a stock, how I find the next great stock, income statements, balance sheets, cash flows, all those sorts of things. I run through that in my course curriculums in the private group, as well as access to our Discord chat, the moves I'm making each week, all that sort of stuff. Much love and have a great day.